today's webinar. Today, the discussion is on the factors which drive the market. Particularly, you're going to look at the impact of FII flows, then the interest rate, and upcoming budget impact. Now, you all know that what drives the market is the money, right? So, anybody who puts in money, I think any investment for that matter, whether any other asset for that matter, whether it's land or whether it's gold or anything else, the market moves because of the supply demand. And once the demand is in excess of the supply, it goes up. This is a very common economic theory. So here, when the money chases stocks, then the stock climbs. Now, why should it chase? We will come for so many reasons. But the underlying thing is money flow is there, which in terminology, in certain terminology, is called as liquidity. So when the liquidity is very high, the markets generally try to perform well, because the first thing that happens when the liquidity is given is the markets go up, and after some time the liquidity goes into real economy. When I say real economy, it means the normal production related ones. That is, for example, companies which want to grow, so they seek credit for expansion, working capital, term loans, and then service industry seek some funds for their expansion. So those are the aspects which where the credit flows into the real economy. So that gives the jobs and that gives the actual growth. But initially, when money is available, and the real economy, when it doesn't seek that much of funds, because they are still in coming out of a shock of a pandemic, so they would like to ensure that things stabilize and there are no negative factors. So before they seek funds for investment, so the real economy will normally lag the market. So that is what we should know. If the market goes up, the real economy follows that later on. So market is always a leading barometer of what probably can happen to the real economy. So if the growth in the market is happening like this, we should translate that into a potential growth in future. That is what is very important, because market runs again. We may think that the market, the real economy is not performing that well. Real economy this year is in a fall, in the sense the GDP growth this year is expected to be something like, according to RBI, this financial year it could be -7 to -7.5%. So the real economy has shrunk compared to last year. But where has the market grown? The market compared to last year is up more than 15% approximately. Right? So this 15% does not reflect what's happening right now. What's happening is that it expects probably the next year to have a good growth. So that means it is factoring these 2 years. That is, one is a fall of -7.5%. Okay, that has been factored already. And that happened, so when the fall took place, I think all those things got factored in that particular March period itself. Because compared to the previous March, this year March, that is 2019-20 fiscal year March, was down. And that was reflecting the fall in the economy for this particular year, which is happening right now. But whatever that's going to happen in future, that is the next year economy, I think that is being predicted by the market. So that means the growth which is coming at 15% in the markets should roughly translate itself into an approximately, the market is expecting at least an 8% GDP growth next year, 8 to 9% GDP growth. So this is what the market tells us, that the real economy will grow at around some 8 to 9% next year. So now we are not bothered as a trader. Should we be bothered about it? Now, you have to trade with, there are two things, important things in the market. One is that you should trade with conviction and you should trade with patience. So what very important things in market are, these two things are very important. That is patience, okay, conviction. These are two essential ingredients for you to make long-term money. Okay. So now, what do you mean by, of course, all these things, terminologies you can easily understand in the real sense of it. But when you say conviction, how do you get conviction? Okay. Now, if big people who are bigger than us, they are bullish, then in that case, it gives us a feeling that we should also be bullish, because we normally follow what the leader does, right? So when big brokerages, when big fund managers, when big investors, when foreign institutions, they pour money and they express a sense of jubilation over the market rise and expectancy about the future market rise, it should give us a lot of conviction that probably we should also be on the same side of the market. Sometimes you will hear noises saying that the market is ate up, market is quite saturated, and there is a bubble. So when we keep hearing all these things, then we need to be careful, because the leaders say that probably we are the market has gone too far ahead. Okay, but right now the signals that comes out are that yes, market has run up, but at the same time we should not be worried too much. And if there are some falls because of some correction, because due to certain factors, then it is a buy, and they expect further and further rise in the market over the next few years to come. So this is the general impression that we get. So we should should give us a lot of conviction to stay in the market and to stay in a bull rally. Question is that you can always fine tune about how you should enter the market, whether you should look towards buying on every dip or every correction or every SIP plan. All those things are a strategy. The conviction, general conviction, is that okay, the broad market, I'm not talking about individual stocks, the broad market or the broad indices will generally climb higher. Okay, and that we have seen even in the case of Nifty, despite all its fall, it has registered in 1 year, it has come up to 15%, right? In 3 years, the rise is approximately 11%. In 5 years, it is 15% or so per annum. So these things we have seen. So that means even after a big pandemic, we have seen a creditable performance as far as the market over any particular time frame. So this now, since one of the big crises is now in the rear view mirror, in the sense that after 2009 Lehman collapse, the next year and subsequent years the market saw its rally. Now similarly, now the pandemic situation seems to be getting under control in India at least, and with the vaccination in progress, we should expect things to settle down in the next couple of months globally, which should see the market coming back, economy coming back with a lot of optimism. Okay, so right now, despite the gloominess in the market in the world in the last couple of months, at least now it is better. But say in July, August, September, we still saw the market going up. So the most important factor was the investment, right? So investment, as I told you, the demand supply, and the demand has come in the form of an FII investment. So money has poured in. So why should the foreign institution pour money into Indian market? We will leave the Indian market's attractiveness, Indian stocks attractiveness, all those things aside. The most important thing that globally, the low interest rates. Now US and Europe are now having real negative rates. Real interest rate is negative. Real interest rate is negative. Okay, this fundamentally is the driving source of the market going up, not only in India but globally. So we normally track whatever happens globally, that we cannot be isolated. On some days, yes, it can be up and down movement, certain breakdown in correlation can take place, but over a period of time, we are aligned with the global market. So globally, what fuels the market rally is a very, very low interest rate, which has turned even the real interest rate has even turned negative. That means probably even the inflation is slightly higher than the interest rate that people get. So that means what happens is that much of now that particular money which is available, so much of printing of money is taking place, so much of money circulation is taking place. So there must be some avenue for investment, right? Now, if I go and invest in FD, okay, now so we will try to mix that interest rate and the FI investment now. Now, let us say even in India, now when you make an investment, you look at different possibilities of investment, what return that you get. You've got varied potential, right? Now, it's starting from PPF, then National Pension Scheme is there, then Post Office savings schemes is there. So then bank FDs, right? Bank FD. Then you got debt papers for investment that can be expressed through mutual fund debt papers. Then you have the equity class, okay, then that can be broadly divided in many form. Then you have got the gold, okay, then you have the real estate, right? So you have got different investment, all these things are investment possibilities. So when you assess the investment possibility, you look at from different angles, right? One, what do you look at it? You are looking at what probably the first importance is interest rate. What can I get? Second, is there any tax benefit that I get? Then it can be the liquidity, that is in terms of whether it can be sold or bought easily. So these are determinants in your investment decision, right? So one of the most important decision is what is the yield that you get for your investment. And also different people have different expectations. Those who are senior citizens may be looking at a little more stable interest rates, okay, stable returns on their investment. The really earning potential people and with high interest rates, with high salary brackets will be looking for whether tax benefit you can get. Also, liquidity plays an important point because even if the real estate now, of course, it may not have given a good return in certain areas, but in certain pockets, probably yes, even then it could have given a return. But the question is that can it be bought easily? Now, if it is a gold or for equity, you can even buy for 10,000 rupees. But that's not possible in the real estate. So you need big amount of money. Assuming you've invested also a couple of lakhs or a crores also, then at any time you want to sell, whether it is possible to sell that easily. So the liquidity also plays a very important part. So when the interest rate, we have got now in Indian market is now open for both domestic players as well as for foreign institutional players, right? So when we look at the interest rates in India, let us say the bank FD which offers, which is what probably everyone knows very easily. All the post office savings scheme, probably they are all in the realm of around 6% per annum. So the 6% per annum, you would like to make it at least 8% per annum or 12% per annum or 10% per annum with a little bit of risk, but with a lot of concern for safety, right? So when we ourselves are looking at 6% is not attractive, then if in US or in Europe, if the interest rate is negative, real interest rate is negative, and actual interest rate is close to 0%. So why will they invest? So assuming here also in India, if somebody say in any particular case interest rates fall down to 2% or 1%, will you still be interested in investing in those low interest rate? You will also be looking for if there is a risk. Now itself, people are saying that at 6% and 7% is no more attractive to be in FD because post tax return you're going to go for a very less amount. So why not invest in something where probably the return can be higher? So this is what probably the general expectation and feeling is, right? So you normally look at something which can give you a better return. So you're now turning towards which are the ones which can give. Maybe it could be equity, it could be gold or like that. So when we are looking at it, FIIs also will normally look at it. There is as we said, there are two classes of big investors. One, of course, the FII. Then, of course, we have the domestic institutions. The domestic institutions are normally, we have the insurance companies, we have LIC, okay, primarily leading as a domestic institution investor. So many other insurance companies and banks and high net worth individuals. So they form the domestic institutional investor. FIIs predominantly, they invest in big stocks. FII investment normally is predominantly in large cap, multi cap and big stocks compared to, because the liquidity is what they want. Okay, DIs generally trying to support even mid cap stocks or small cap stocks, but FIIs generally go for heavy. That is why whenever the FI investment comes, the index goes up. In the last 1 or 2 days, if you see, there will be some pull out that is taking place of FIIs. So probably that is the reason why we are not seeing the market rallying further in the last couple of days. But if you look at the overall statistics of FII investment in this year, financial year, that is date from April till date, the amount of investment that has come from FIIs is something close to 2,25,000. I'm not giving the exact figure, but I'm just saying 2,25,000 crores. 2,25,000. Okay, 2,25,000 crores. Okay, 2,25,000 crores of investment has come from FIIs. 2,25,000 crores of investment has come. This is one of those years of big investment. This is one of those years of very big investment that has come from FII. So there was a big pullout that took place in February and March last year. And right now we have seen market every month. Last December itself, there's something like 40-50,000 crores of investment that came into equity markets. So that amount of money, if it comes, then probably for some period of time, the fact of valuation and whether the stocks which are being bought or ought to be bought, whether it is being purchased at a right price or whether it is too high to be still be held, these things normally debates will come. But all those debates for the for a period of time, the liquidity will hide it. But over a period of time, after some time, when the liquidity expansion stops, or the printing of money stops, or the money flow stops, or the low interest rates is now being stopped and interest rates are pulled up. If one of these things happen, then everybody will jump onto the valuation, whether the market is, what is the valuation, why it should have gone up. So when you see the market falling, you will always have the reason saying that valuation has been very high, so investors have come to book profit, and so there's an unsustainable valuation. So you will see one debate raging once the market starts to fall. When the market starts to rally, I think everybody will talk about either if it's coming from such a low level, there could be two combinations, both valuation and liquidity. That is going to be a very potent combination. A low valuation and liquidity. Suppose if the markets are with a low valuation or low to medium valuation, and liquidity with low interest rates. This is a potent combination for the market to go up. Okay. Right now what's happening is liquidity remains, but the valuation is stiff. There are a lot of debate because there are a lot of stocks which are great stocks, but with a very high valuation. For example, Asian Paints, very highly valued, but really great stock, and a great stock also probably in future. But once the valuation is very high, there's a reason for a bigger correction to happen. Lot of FMCG stocks, lot of stocks normally in India are being chased because those are very good stocks. That doesn't mean that a high P ratio, that is high valuation companies, or something where we should not invest, or whether we should go out of that stock. That is not the benchmark of deciding anything. But it's also something which has to be kept in mind, that whether the correction can be a little more aggressive in those stocks which have already run up very significantly but suffering from high valuation, because money can be pulled out of that and probably they can put in for some other stocks which are now at slightly low to medium valuation. So right now what's happening is that the stiff valuation, then you have the liquidity issue. So these are two things right now which are opposite factors. One is the stiff valuation, and as against that, liquidity pouring in. Okay. Till now, the liquidity is what is winning the game, and the valuation, stiff valuation, is still being ignored. Now, when we talk about valuation, the most important fundamental factors they talk about is a PE ratio. So when you talk about valuation, they talk about PE ratio. So if you look at it, this is what is talked about, or price to book value. So we're not going too much in detail about this, but fundamental factors, if you look at it, I think the one thing which which probably the market will, or if you look at any channel, hear any news about a company, generally they will talk about whether the price to earnings ratio and the price to book value ratio. Okay, for banks normally they talk more about price to book value ratio, and for other stocks normally they talk about price to earnings ratio. So what you talk about price to earnings ratio, it's nothing but generally a profit after tax. There's a profit after tax divided by number of outstanding shares. So PAT you can say divided by number of outstanding shares. So this is one way of looking at PE. The other way is PE is nothing but market price by EPS of the share, earnings per share. So this PE, normally, it will keep going along with the increase in the price capability of or the increase in the profit after tax, right? So because if the profit after tax goes up, then the PE will always go up, right? So there will always be an expansion with the same number of shares. So if you look at the profit after tax growing at say 20%, 15%, 20%, then in that case we should also see the P expanding further. Okay, so that is where the market now is estimating. Now what they are looking at now, the index is close to index. So now the index is let us say 14,200. Okay. Now the P approximately right now stands maybe at around 37 or 38. Let us say 37. Okay. Now that means the EPS of Nifty is 14,200 divided by 37. It's 380 approximately. Let us say 385. 385. Now, if you talk about this only 37, which is a trailing, that is still now for this financial year, this is the estimate of 385 because earnings are generally down in a year compared to the previous year because of the pandemic. Across the, I'm talking about entire this one because April, May, June being a washout period and July, August, September being a very tepid quarter. But what generally right now they are looking at is the next financial year because market, I told you, is always a leading indicator and it's a barometer of what is likely to happen. Now they are already talking about this particular one goes about 650 EPS. They're talking about 650 EPR and normally Indian market generally does not come much below the 20 PE. I think getting below 20 PE is not going to happen. Getting below 20 PE in a bullish market does not happen much in India. Okay, so Indian markets are generally a very pricey market. So if this is the figure that we are talking for the coming financial year, which is going to start 2 months from now, then in that case, getting this market below 13,000 is not going to happen. Less than 13,000 is not going to happen. So now market is 14,200. So getting this below 13,000 is an unlikely scenario. It's a very, very unlikely scenario below 13,000, generally speaking. So if we look at it, something Indian market generally is going at 650 into say 21, 22. This is where it is. Then we should only get something like 650 into 22. This is 14,300. Right? So for next year, I think right now the market is being there at this level. I think despite all the this one, so unless this particular thing is downgraded for some reason, so the earnings season is very, very important to get a clue of what's going to happen. Now the market is guessing that probably we will be somewhere around the 650 earnings per share next year, which is a considerable jump because when you're talking about 400 approximately and 650, we are talking about something like more than 50% growth, right, in profit after share, which probably for the particular this year being so bad, awful, now they're expecting the jump to happen significantly up to this particular level because of the pandemic. The overall market has got crushed for profit, so they expect that probably next year we could see a very important expansion that could take because in the previous years and all, if you see, the EPS was something like 450, 475 it has reached. So that 450, 475, from there it has to increase further over a period of, so it is going to catch up with this particular year. That's what the expected thing. So even if you have grown at some like 10% these 2 years, they are expecting that the EPS to be more than 600 and approximately even 650 levels, which should give something like 14,300. So even at 20 levels, so we don't, so that means when you now, why I'm saying that trade with conviction is that if this figure is something which is probably is the most likely outcome which the market is guessing, then in that case we should not get ourselves on a fundamental basis below 13,000. So that itself provides us a big cushion. From there we can look at how the technicals will play out. So any big correction, to what extent it can correct itself and all. So anything around this particular figure itself, now market is 14,300, went up to 14,700. So a 10% correction in the market, probably it's 1,500 points, it will be 13,200. So we don't expect the market to fall much below 13,000, 13,200 from now. This is a general feeling that we get. And probably it will start rising as the year goes on. It will now forget about 650 because 650 it will be there for October, November, December period in this year. And after that it will look at the next year figure. So if we look at the market to grow, even at around say corporate earnings to grow at say even 10% or so. So this should translate into 24 or so. So 650 probably even into this particular earnings, then in that case should become something like assuming 720 or so. So 720 into even 22 should make it a base case scenario of 15,840. So by closer to this year, after a fall, probably the rally could even take it right up to this particular level, which is 15,840 level. So I think now this is a sort of conviction that will give you that you need to buy the market on some dips. Let us say the market now is 14,300 and you are able to get it closer to 13,500. And from 13,500, when you are getting closer to 15,840 at some stage, which means around 1,300, 1,400, which means it's going to be more than 2,000 points within a year. So the rise could be something more than 10 to 12% or so. So when we play for this game, then in that case, we know with great conviction that now, then from there you look at the strategy of how exactly you would like to do this. How do you want to strategize your trading methodology in all this thing? That you can look at it now, because market now being high, as if you feel, then in that case you go for a SIP scheme, because if you get a lower level, then you should have money to invest. So when your market is quite eaten up, or the valuation is quite decent enough, it has built up this decent figure, then in that case what you do is that you go for an SIP scheme. So you will be able to average it out. But whenever it falls to some lower level, which is 10% or so from the top, then in that case you go for a higher investment. Maintain that SIP and just go for a slightly higher investment during that particular period of fall. Then in that case your overall return is going to be significantly good. Okay, so that is what you are looking. That is how you normally. That is what you normally look at it. How you basically get a conviction to trade the market on a bullish scale. Because if at all you are going to be a bear in the market, then it has to be for a very short period of time. Because we have seen that normally bearish trend, except for a couple of periods, it just lasts for a couple of months and starts going up. So you need to really fine tune your bearish strategy. But whereas if you are in a case of a bullish thing, you don't need to fine tune. I think it will go up at some stage or there. So every fall, you look at it from a point that where you will go for some investment. Then in that case, you don't need to worry about it at all. You can definitely go for an investment at the for all these things. So this is how you normally look towards planning your this one investment. And now when you are looking at let us say the impact that budget can have. Now budget is a very, very important event as far as India is concerned, because the policies the government enumerates, normally they keep budget day as a day to announce the fresh directions by which the government wants to pursue. Because there can be over a period of time government keeps announcing various policy reforms, but budget day they usually reserve it to announce certain important and big steps, this one. And also of course in India we are all used to listening about tax proposals more closely, particularly the direct tax proposals, because the indirect tax proposals like GST now has come out of the budget domain. It is now with the GST Council and more or less well set. So the most important thing for the individual will be normally on what probably the direct taxes will bring, and then later on probably some of the other important policy measures the government plans to announce. But whatever said and done, market generally feels that during the budget day it can be quite volatile, which can happen because of the swings it can create. Because if you see from the previous day close on the budget day close, the close could be even 1 to 2%, not much like it happens even on ordinary days. But within that, there could be wild swings. It can go up by 3%, 4%, then it can fall down by 3%, 4%, then settle down. These things have happened. Now, let us look at what has happened in the previous budget period. See, we have given a detail of budget day facts. That is, every last 10 years, who were the finance ministers who have presented the budget, and the budget day and the day returns compared to the previous day, and the day high and day low compared to the previous thing. And if you see, the overall thing is that in the last budget, in fact, the day return, that is compared to the previous day, the market was down by 2.5%. The market was compared by 2.5%, and in 2013 it was down by 1.8%, and the best was in 2017 when it rose by 1.8%. So compared to the previous day, if you look at it, the difference is well within acceptable limits. It's not that it is completely gone hoary in the last 10 years, which means there are a lot of things which the market expectations either have been met, or the market is not too overtly disappointed. That is what these facts give about the day returns and this one. But within a day, there can be wild swings, like day high, if you see, it goes up by 3%, then settles down 1.29%. Sometimes in 2013, it went down by 3%, then came back by 1.8%. In 2016 also, it went down by 3%, but came down. So I think more or less we see a swing which could be as low as minus 3% on a budget day, generally speaking right now. And on the upward swing is limited, in fact, not much. I think other than 3%. So I think there is a chance that probably we could see a plus or minus 3%. That is what it looks as if the budget day can happen. So that means when you're looking at plus or minus 3%, it means significant from the 14,000 level, because it could be plus 500 or minus 500. So that is why probably on that particular day, whether the previous day, if you buy a straddle, because for first is on Monday, and then the next expiry is coming only on 4th. And for 4th, the price is quite expensive. Now, if you look at the option price, it is very, very expensive to look for the option. Now, I don't know what's the price, but we'll try and see whether we are able to look at the price right now. You can have that session even on Friday, because so this is the option chain. So we will look at the 4th so 4th February, 14,300. Right now the market is closer to that, right? So it is 221 rupees, very expensive, because it's just 9-10 days away from here. So 231 rupees. So the market is expecting, even if you take the same thing, like 14,300, and if you 225, 226, so you just expect that the jump is, if you expect it could be 2 times, let us say, of 225, then it comes to 500 points. So that is what the expectation is, that it could be something like, it could go down to 13.8, or probably it would go to 14.8. That is what it says. So that is all they have factored. That no, if you're before 4th, if you're buying a straddle, I think the entire chance is that they want to make you as much of less profit as possible. And so the 14,300, if 225 and 225 you buy 550 rupees. So 14,850 to 13,800. So the market is expecting that probably it may not be much above 14,800. It will not be much below 13,800. So it doesn't want you to make a money. If it doesn't want you to make a money in straddle, then this is this is what it is building up. So expect that probably the straddle, if it is going to give a risk neutral thing, then in that case you are expecting something which is 500 points from here, and that is what we have seen in the budget. Before the budget, it is around 3%, right? So 3% is what we have seen as a budget day high to budget day low. So if you are buying a straddle here now also, then we need to get a swing which is more than 500 points for us to make money. So that is where we have to keep in mind that if that does not happen, then immediately the volatility will shrink. So the option is not going to allow us to make the money. So what we have to do is that we have to take some directional call, hoping either the market goes up, or if it's going to swing, then in that case we don't need to worry too much about the thing, because even if you buy, the recent high has been 14,700 approximately. So if it is going to rally, then in that case we need to just look at 84 rupees is the option premium right now. 84 rupees is the option premium. Either we pay that, or probably since the market can swing very clearly on the upside, in case if things are quite good, then in that case we can buy approximately in 14,200 being a very important support. We can buy something like 14,200 call, which is around 277 rupees, and probably sell a 14,800 call for 58 rupees. So 277 minus 58 is approximately 200, 220, 230 rupees. And we can get a profit which is 600 minus 200, so around 370, 380 rupees profit we can get. Or if you don't want, because if the market is going to exactly very big jubilant after that, in case you don't need to sell even a 14,800, we can just look at something like 14,200 call we buy for 277 rupees and leave the trade. Because either if you sell the put and all, it will not probably will not have much. So I think the ideal thing will be to go for a call which is 14,200 call at 277 rupees. But what we need to be very much clear is that after the budget day, this volatility will shrink. This volatility will shrink. So we will not end up with a huge profit on that day. So we have to look at some other day. Suppose in case if we don't look at 4th February, but look at 28th February, 25th February, which is the month end expiry. It is around that is going at 434 rupees. That is going at 434 rupees. So in case if the market again sinks, then in that case we may have a loss which is 430 to 434 rupees. But let us say we sell a 15,000 call, is 115 rupees. So we can try that also, 434 minus 115, and we may end up with something like 320, 330 rupees, for which we have an 800 rupees profit. So in case we got a 500 to 600 rupees profit swing, that is possible. So we can look at this particular decision also, and then probably if you feel market is unlikely to go below 13,600, we can sell. But again, those things are quite risky. So we just confine ourselves to buying a 14,200 call, and probably sell a 15,000 call for 115. So that will give some 325 to 330 rupees, which is worthwhile to take the risk, because in case if we are on the budget day, if everything is good and extremely well, volatility for 15,000 is going to come down. If the market is going to pierce at 14,800, we can even think of removing the 15,000 call and run our trade also significantly. So we can look at this particular type of structure, where probably we just go for buying a call, or we can go for a call spread. Okay, either we can look at the month end, or probably we can look at the February 4th, because these are two areas, because other things will not have much of liquidity. So 4th February is very closer after the budget day. Probably one more day you will have some impact as far as the budget features is concerned. So that we will come to know clearly, because the market will try to digest all the facts which has been presented in the budget on the budget day. And so if there is some negative reaction, probably the negative reaction can go off, and probably the market can bounce back also on Tuesday. Or if it is extremely euphoric, but after some time it will digest that it's the fine print is not that great, then probably there can be a swing on the downside. So both things are possible. So trading on the budget day definitely requires not to take on the future side, but to take on the option side. And very clearly, if you want to avoid trading, fine. But if you want to get benefited by that, what is the maximum risk that you can take? Express that in the form of an option. Of course, the option has a huge volatility factor, so which probably can hurt you once the volatility subsides after the budget. For which reason you can also look for a call spread buying, which could be a 14,200, 14,800 or 14,200 and 15,000 for month end. So this is as far as the broad market is concerned. See, one sector which normally will not get affected is the IT sector, right? So IT sector normally is more or less immune to budget day thing, because most of them are global in nature, and so here and there some policy changes will not affect much. But it is the consumption companies and as far as the infrastructure companies probably which will look, and the banks, which probably can get impacted by budget policy announcements. Now, auto sector, probably there can be some announcements regarding the scrappage policy. Then there can be something towards the bank on how to finance big infrastructure projects. Third is how to address the bank NPAs. So these are the issues probably, and also some more amount of focus on agriculture. So these are areas where probably the government will try to announce certain structural measures to because now the economy has started to come back. Now there is a pent-up demand which has put the economy on the back growth. But after that, I think the normal demand is also coming. All good, all indicators are justifying that probably we are getting out of the pandemic quite sharply, and we are in for a better period. So at this point of time, whatever support measures that needs to be given by the government, I think they will give in order to ensure that things move up on the upside. Already a lot of focus has been there on the housing side. So, but the question is, all sectors will get something. Now, if we are focused excessively for ourselves on the particular sector, thinking this sector there will be a bonanza, so I will go more for that particular sector, it is a risky thing, because if such policies don't come, then in that case we will get the market can thrash out those particular sectors, or if there is disappointment in announcements. So generally better not to put your money into sectoral funds at this point of time, because unless there is a big clarity coming even before the budget or information is leaked. But what is very important is that if at all those sectors go up, it will also have an impact which is positive or negative on the index. So it is better to play on the index itself. But the overall thing is, even if the market is to get down after the budget, then in that case what probably will still drive the market is the economic growth which will come back this particular year. The strong corporate earnings which is being expected by the market. Third is the liquidity factor. Ultra loose policy will be kept on hold at least for next 2 years by Fed. Global central banks will keep the interest rates low for the next 2 years. So that means now all our investment avenues should be more or less focused on equity related issues, rather than going for very, very conservative deposit scheme. So we should be more looking towards at least a 10%, 12% in equity growth, which will be even obtained in index or related type of investments. So with this, I would like to conclude today's webinar. So you can ask your questions now. Thank you very much. So if you have any doubts, you can ask now. I think the next will be on Friday, when we will review all the developments that took place in this expiry period, in the January period, and take a call on what should be done as far as February series is concerned. So thanks for participating. So happy Republic Day and great holiday tomorrow. See you again on Friday. Thank you very much for the participation. Bye. Thank you.